What's up, guys? I'm back for another video today, and I actually wanted to get into this video for probably about a month talking about retirement accounts. So, as we all know, we all work, or at least most of us work, but we either have 401ks, Roth IRAs, etc., 403b plans if you're a teacher. Basically, I'm going to tell you about retirement accounts. Now, I'm going to get into traditional and Roth, and that's it. So first things first, what is an IRA? An individual retirement account. I got the book in front of me. Let's get to it. So basically, your IRA is for retirement, yes, but it's either tax deferred or tax free way. So tax deferred means you don't gotta pay taxes till later. Tax free means as it is, you don't pay taxes on it. And it's a way for you to save for retirement. Most people think of it as an investment. It's not necessarily an investment, but it's a container where you can keep investment items. So you can keep stocks, bonds, mutual funds, etc. And investments, so your IRA, you can have securities, certain government coins, and you can also have real estate in there. But you may not invest within collectible items such as antiques, paintings, rugs, diamonds, and stamps, or life insurance. You cannot have that in any type of IRA. It's illegal. And because they are tax deferred or tax exempt, municipal bonds and municipal funds are not beneficial to it. But let me get into the real basics, things that you need to know about them. So IRAs, traditional one, an intro to this is that they are tax deductible. So contributions are tax deductible within limitations because taxes on the contributions and earnings may be deferred until you retire. So therefore, you can take withdrawals when you might be in a lower tax bracket when you're older. And the plan is designed for people who receive compensation. So when you work, and you usually control them yourself. So you either have a spousal IRA with your spouse. So if you have a spouse that does not work at all, they can have one open in their name, but may have limitations, etc. And then the assets of one IRA may not be rolled over when both are alive. So when you have a traditional IRA, let's say if one spouse is still alive and the other one is too, you cannot roll over from that spouse to the other spouse, if you understand what I'm saying. So you two own two separate IRAs. You cannot roll your husbands to your wives or your wives to your husbands. That's not allowed. But for your retirement account, contributions may be made up to the lesser of 100% of your earned income or any specified limit. So they're aggregated, and if you're at least 50 years old during your tax year, you may contribute an additional catch-up amount if you want to add a little bit more. So basically, a traditional IRA, they're tax deferred, contributions are aggregated. If you're 50 years of age, you can have an additional catch-up income put in there, and less than 100% of what you earn up to specified limits may be contributed. So basically, what happens if you put in more money than you're supposed to contribute? You have a thing called excise tax, which means excessive tax. So you may have a cumulative 6% tax on that because you are not supposed to contribute more than, I think it's, around 14K. I'm not sure, but it's around in the double digit numbers for the thousands. And if you contribute excessively, they're going to tax you on that because it said this is a certain amount that we're going to have you put at. And if you want to go over that, you're going to get penalized. So you guys just follow the rules, guys. Follow the standards, follow the guidelines. And contributions must be made in cash up till April 15th of the year following the year that deduction is claimed. So what I'm trying to say is that tax season comes around, you have until April 15th for the previous year. So if you were doing one for 2022, you had until April 15th of this year to contribute to your IRA. That's what it is. It's basically telling you that hurry up before tax season comes because you might have to pay tax on that. And that's what happens. You got to pay tax on everything basically. But it's IRA. It's your retirement account. So whatever you have is tax deferred or tax exempt. You want to get the tax exempt. But here's the deductions part. So say that you're going to list it as a deduction. When you are not active at this retirement plan or traditional IRA at work, not active, you can deduct everything up to the limitations. So it just depends on your adjusted gross income and if you're not part of the plan. But if you are active in a retirement plan at work, so say if you have yourself a 401k at work, then you may be able to deduct a contribution to your IRA depending on your tax bracket. So wherever you file is during your tax status, you can deduct that as a contribution. And also, if you're unemployed person, well, spouse, you may have the same contribution based on your employee's compensation. So basically, individuals with an unemployed spouse, and it says right here, you may make the maximum allowable contribution for themselves, and your unemployed spouse may also make the same contribution based on the employed spouse's compensation. So basically, you can put in whatever your spouse that is unemployed, they can put in the same amount that you put in, up to the contribution limit, that is. But let's talk about taxes on earnings. So for a traditional IRA, a traditional retirement account, taxes on all earnings are deferred until withdrawal. That means you can wait until you withdraw them to get taxed. Isn't that amazing? You build up, but then at the end, you're going to get taxed. But like I said in the beginning, it says when you feel like you're going to be in a lower tax bracket when you retire, that's helpful, because if you're lower on the tax bracket, lesser the tax. Higher on the tax bracket, higher the tax. That's how it goes. So it may begin at age 59 and a half, but here's the thing about that. You will receive a 10% penalty if you're between the age of 59 and a half and 72, or basically 71.999. So basically a day before your birthday, but 72nd birthday. But because you're taking out 59 and a half, let's just say you have to do it for death, disability, medical expenses, first time home buying, educational, etc. Things that are qualified distributions. When you do that, you don't have to worry about tax. But if you're taking it out just to say I want to take out money, 10% if you're before your 72nd birthday. So between 59 and a half, which you may start at, and 71 point day before your birthday when you turn 72, 10% tax, that's it. And for example, say if a person wanted to take $10,000 a year and they want to take out $6,000 instead, that $4,000 will be subject to a 50% penalty based upon life expectancy. So, and that's talking about our mandatory by age 72. So when you're 72, you got to take it out. It's mandatory. It must begin no later than April 1st, following the calendar year when you reach 72. And if you decide to say, nah, I'm just going to go ahead and take my money out at 73, 50% tax. So just take your money out. Just be happy with your money, take it out. So obviously I know my audience is not old, or if you know anybody, your grandparents, etc., or your parents that are reaching that age, tell them, don't wait until it's too late to take out your money, because you will be taxed heavily on that. But first-time home buyers with a traditional IRA, you don't have to worry about that 10% tax I said a little while ago, up to $10,000 of distributions to buy, rebuild, or build a first home. So, rollovers. Say if you want to take it out of a traditional IRA and roll over somewhere else, you got 60 days to do that to your other IRA or qualified plan. 60 days. Tax-free rollovers are limited to once every year if the rollover is an IRA to IRA rollover. And that is the law or rules about that. But let's talk about the Roth. Everybody loves Roth. I have a Roth. But let's talk about a Roth retirement account and why it's so popular, why people always tell you to get it. It's very short for this one. Hopefully you guys learned something from traditional IRA. If you want to go back and see what I said or hear what I said, go ahead. But this is Roth and I love it. Here's the thing about Roth accounts. They are not tax deductible. Now you're saying if they're not tax deductible, then what? Contributions on a Roth, their dollars can be withdrawn at any time without penalties, because your contributions can be made tax-free. And this is for people who anticipate on being in a higher tax bracket during retirement. So traditional IRA is for people in the lower tax bracket during retirement. That's your anticipation. Higher tax bracket during retirement is anticipation of those with the Roth IRA. And it's a plan designed for people that receive income. So basically, Roth IRA, you don't have any penalties per se because it's not tax deductible from your gross income. And they can be withdrawn anytime without penalties, but you're saying, well, what's the catch to it? Here's the thing about the Roth IRA. Despite it being not tax deductible, you have a 5-year holding period for distributions. So your distribution may not be made before the end of the 5th year, after which you made your initial contribution to the Roth IRA. So you're saying, I gotta wait 5 years. Well, you have to wait 5 years to have a qualified distribution, which means contributions and earnings are tax-free when withdrawn to have a qualified distribution. But you have to satisfy two things: the 5-year holding period I just said, and meet one of the following criteria. It's made after you're 59 and a half, made as a result of the death or disability of the IRA owner, qualified first-time home buying expenses, educational expenses, or medical premiums. So that is for the Roth IRA. So basically, you can still contribute to that and you can still get qualified distributions to it. It's just that you have to satisfy the 5-year holding period and one of the many I just said. I think that's 5 things I just said. So basically, traditional IRA, if you expect yourself to be in a lower tax bracket when you retire, it's better for you. It just has a lot of things going on with it, but you get to wait for your money. And when you're using a Roth IRA, yeah, it's good, but at the same time, you have to wait. So regardless of anything, you're going to have to wait on your retirement accounts because they are retirement accounts for a reason. So non-qualified distributions that don't satisfy those requirements I just said for the Roth will be included as gross income and generally taxed to the 10% penalty. So whenever you receive a penalty on that, besides the late tax one to the traditional IRA, which is 50%, 10% tax. You want to go early, 10% tax. You want to withdraw early, 10% tax. Remember that. 10% tax if you want to get out early. And the rollovers between Roth IRAs can be done tax-free. And they can be rolled over, well, traditionals to Roth can be rolled over with certain restrictions. Amounts transferred will be taxable to your ordinary taxable income. So basically, what would you choose? Not giving you advice, but I just told you, you make your decision. And that's it for this one, this retirement accounts. Hopefully you guys got something out of that because it's a lot. It really is. But the main thing I want you to take away from today is that traditional IRAs, regardless, Roth IRAs, regardless, you can take out your money, but you can be subject to 10% tax, but you also have qualified distributions. So if you want to buy a first home, rebuild a first home, you're good to take out. If you want to go ahead and use it for educational, medical, that's good. You can take out. You won't be subject to the tax. But if you just want to say, I want to pull my money out, you're subject to the tax. So remember, you will be taxed upon taking your money out early. You will be taxed upon traditionally in an IRA for taking your money out late. So you got 59 and a half to 72. And for my audience, if you're not within that age range at all, you don't got to worry about that because the rules may change as we get older. But for right now, you want to tell your parents, your grandparents, etc., anybody that you know, tell them this and make sure they understand what happens to their retirement accounts if they don't handle their money correctly. So guys, thank you for watching. This is kind of a long video, but it's very informative for retirement, and I will get to you guys next time. Thank you.